Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Joseph Zipfel of SFC Capital to talk about their SEIS and EIS funds. Joseph, tell me about SFC and also give me some history of your own experience.
Yeah, sure. So SFC Capital, formerly Startup Funding Club, we've been around for almost 10 years now. We specialize in SES and ES investments in early stage companies across the UK and across various sectors. For the past 3 years, we've been named the most active seed and venture investor in the UK. We've got a portfolio of almost 300 companies now, which is one of the largest portfolios of early stage companies in the UK. Over £50 million under management, including 30 million of SES money. We've also raised investments from public organizations like the British Business Bank, previously the London Co-Investment Fund, that get co-invested alongside our SES and ES funds. Myself, I'm the Chief Investment Officer at SFC. I've been with the company for 8 years, and I manage everything from the investment side and also working on the investor relations.
Okay, and talk to me about the EIS and SEIS funds. What's their objective? What do they aim to do for investors?
Sure. So our thesis is that you have a wave of innovation happening in the UK, which is actually getting stronger every year. And it's creating opportunities across many different sectors, from life sciences, medical technology, all the way to financial services, and also consumer goods and technology. And our SES and ES funds have been designed to invest in the most ambitious, innovative startups across all these different trends. So in many ways, our model is quite simple. So we operate an SES fund, which is a pre-seed fund. So that invests in up to 100 companies per year, new startups. So those very early stage investments, so typically the first funding rounds of these companies. We source them from leading universities, accelerators, angel investors as well. And we then have an ES fund that focuses on the top 10-15% performers coming out of that SES pack. So typically by then, companies have proven the model, they're generating revenues, they've got clients, and they're looking for capital to grow. And because we're existing investors in these companies, we have the option to participate in all these funding rounds, which is extremely valuable because as these companies do well, their funding rounds become highly competitive. And not every fund is able to participate. And quite often we find that companies skip the ES funding round sometimes and go straight for an institutional fundraise. And we're still able to participate because of our existing shareholding.
And how many companies would you have in a portfolio?
Sure, so we run about 3 tranches per year of each fund. So if you invest in the SES fund, you can expect on average to have around 25 companies. That might vary according to the time of the year. In the ES fund, it's usually around 10 companies. It's worth mentioning that we are very aware of the admin side of claiming the tax relief for investors. So we do assist investors. We provide all the information they need to claim the tax relief easily, so they don't have to dig up information across dozens of certificates.
And it sounds quite a lot to have 25, 30 companies in an SEIS. Why so many?
Well, under SEIS, you're limited in terms of the ticket size you can invest in a company, so you cannot invest more than 150K per company. So we're talking about very early stage investments, obviously. So it's really about funding the early commercialization of those ventures. So you're limited by your ticket size. We also believe that diversification is hugely important, especially at the SES stage. So typically the dynamics are that 10 to 20% of your investments are going to generate 90% of your returns. So you want to have a portfolio that's large enough so that you have 5, 6, 7, 10 superstars that will deliver those high returns, that will deliver the 5, 10, 20, 50 times return on investments.
And can you just go more into the characteristics of the companies you're looking for?
Yeah, sure. So we are generalists, but we do focus on, we've got core sectors of focus. Life science is one. We've got relationships with lots of universities in the UK, the leading universities that have really good incubator programs. We invest in spin-out companies coming out of those universities. Usually those are still SCS eligible businesses, but backed by years of R&D. So we're not talking about concept stage startups that well-funded R&D shops already. We focus on financial technology, which is where the UK has a massive competitive advantage. So we've done quite a few investments in that. Enterprise software is obviously this is where we come from as an organization. Our CEO, Stephen Page, is himself an exited software entrepreneur. So that's about 50% of our portfolio. And increasingly, although we've done that for years, we are focusing on climate tech for obvious reasons. We think that's an area of growth. And we see more and more high-quality opportunities in those sectors. In terms of where those companies come from, so I mentioned we partner with universities, we partner with the best accelerator and incubator programs in the UK, and we also work with angel investors who source deals for us and co-invest with us in these companies. We manage one of the largest angel network in the UK with almost 1,000 members. And those guys basically bring companies to us, co-invest with us, and get involved with these companies alongside us.
And is there any difference between the characteristics other than the size when you're looking for an EIS and an SEIS company?
Yes. So about half of our SCS investments are at a pre or early revenue stage. So you don't have years of financial history to look at. So obviously you're looking to invest in companies that have scalable business models in fast-growing markets. Those are very much the easy bits to assess. We spend quite a lot of time looking at the people. And we've learned over the years, we've developed a method to assess the potential of a founding team and to pick up quite early on the signals of a winning team or a losing team. So the good thing having done so many investments is that you learn from your successes and you also learn from the failures. And now we've got a good method in terms of assessing what are the right incentives, what is the sort of mix of profile that we want to see in a founding team. We spend a lot of time obviously looking at the skills and experience of people, but also their personality types. We're looking for diversity of profiles within the team. Because what we've learned is that you can fix issues with a business, with clients, with the product, but at this stage you cannot really fix the issues with people.
Are there any key characteristics in these people?
Yeah, so as I mentioned, you're obviously looking at the CVs, and again that's the easy bit to assess. You're looking for people with credible skills and experience, but you're also looking for a mix of personality types. So you want to have a driver, a leader in the team, but you also want to have someone that's a bit more operationally driven. You want to have someone that's basically going to be focusing on the more analytical side, the finances, etc. You want to make sure that you've got commercial skills, analytical skills, and really business management skills within the team. You also want to make sure that the company has created the right incentives across founders and senior management. It's very important, because if you have a breakup in the team early on, that can mean the end of the company. So you have to make sure that you pick up those signs very early on. It's very easy to overlook these issues and get excited by the technology or the product. But what we've learned from our experience is that you should never ignore people issues because they always come back to haunt you.
Let's talk about the companies you've actually been investing in recently. Can you give me a few examples of what they are and why? Yeah, sure. So starting with the SCS fund. So this year, I've mentioned financial technology is a sector that we particularly like and focus on. So earlier this year in January, we've invested in a company called Algebra, which is a fintech company, which has the potential to become the next British fintech superstar, hopefully. So their aim is to provide ethical financial products to underserved and underbanked customers around the world. So they have roots in Islamic finance, but truly global ambitions. We were extremely impressed by the team. The vision, the skills, the experience, the products that they're building. And since our investment, so we invested as part of the pre-seed round from our SCS fund alongside angel investors. And since then, they've added high-profile board members and investors, most recently Philip Hammond, the former chancellor,
the former chairman of MasterCard, the former chairman of Innovate Finance, so really heavyweight, industry heavyweights have joined the team. And the products and technology that they're developing is going to be world-class. So we're extremely excited about this company. They're currently raising a new round from institutional investors that will value the company at a multiple of what we invested at less than a year ago. So it really shows how quickly things can happen under SES. I've also mentioned that we're increasingly focusing on climate and green tech for obvious reasons. So we just last month invested in a company called Nuspec Oil, which is based at the University of York. So again, it's a company that's the result of years of research and well-funded research. They've developed a range of oils and lubricants for industrial applications. Those oils are environmentally friendly, biodegradable, clean to manufacture and dispose of. It sounds quite niche, but we're actually talking about markets worth tens of billions that are dealing with severe issues in terms of pollutions and emissions. And their technology is tackling that directly. So again, it shows that SES is not about concept stage startups. We invest in companies that have years of R&D history quite often.
And what about EIS investments that you've made? Yeah,
so EIS, obviously, our EIS fund focuses on the best performing companies. So our EIS investments are a lot more metric driven. So we're looking for companies that have achieved or ideally exceeded their milestones and are raising a new funding round alongside high profile tier 1 venture capital funds. So just last week, actually, we invested in one of our portfolio superstars, a company called Humanizing Autonomy. They develop software for autonomous vehicles. They've developed a technology that can predict the behavior of pedestrians on the road in urban environments. So they sell the technology to car manufacturers, large fleet operators like UPS, TfL here in London. So they've got a range of private and public clients. That company is doing very well. They're raising a £10 million Series A round. And we're the only ES fund able to participate in this round because of our existing shareholding. So it shows that our strategy of having the SES investment as the kind of Trojan horse in these companies to then provide deal flow for our ES fund is working. So that's obviously very exciting. The first investment, the SES fund investment, was in 2018. The valuation of the company now is 40 times what it was back then. So it's obviously great news for the SES investors then. But we still think it has plenty of potential to grow.
Tell me, what about some more mature investments in your past portfolios?
Yeah, so a company I love talking about is a company called Onfido, which is where it all started for us really back in 2013. It was one of the first SES rounds that SFC arranged. This is a biometric company, so it's a company that can verify your identity online. So their technology is used by banks, financial services, so it's that kind of security-grade technology. Since the SES round, they've raised more than £200 million. They have thousands of employees, offices in New York, San Francisco, and London. They're doing very well in Asia. They've grown 200% last year. And they're planning an IPO on the New York Stock Exchange early next year. So the SES investors in that company have done phenomenally well. There was actually a couple of years ago a secondary exit opportunity for SES investor, which resulted in 100 times multiple on the original investment.
And did your investors take that?
Yeah, absolutely. Yeah. So it was a partial exit, so which is actually something that's happening increasingly often. So you can sell part of your shares and keep the bulk of your holdings, so you're exposed to more upside. Upon the IPO, we expect the valuation to be a multiple of that what it was a few years ago. So yeah, fantastic success story. And again, it shows the kind of multiples you can get on a very successful SES investment.
So you're looking after, you've got hundreds of companies in your portfolio.
Yes.
How involved do you get in them, and is it possible to get involved?
Yeah, you have to. So you cannot invest at such an early stage and not get involved. So the way we do that is obviously the companies that are a bit more mature don't rely on us so much. So, Onfido is not a company that needs our day-to-day involvement, for example. So we very much focus our time and resources on recent investments. Our belief is that if you get the first 12 months right in terms of governance, business management, you're in very good shape to then achieve your milestone, raise a new funding round if you need to, or grow organically. So we spend a lot of time making sure that the investments that we've provided is spent wisely. So we spend a lot of time as part of our due diligence making sure that whatever cash we're investing is going to last 12 to 18 months, so the company has the cash runway to achieve the targets. And usually, once the business is in good shape, is growing well, we can take a little bit more of a step back and then focus on the next cohort. We also co-invest with angel investors who often take an active role in these companies, so that is helping us. And we co-invest with other early stage funds, the more specialized funds. The British Robotics Funds actually co-invested with us in Humanizing Autonomy a few years ago. So that's how we go about portfolio management.
And it is risky, so investors going into both SEIS and EIS, I don't know, you might want to treat them separately, they do have to expect some or quite a few would fail, isn't that right?
Yeah, absolutely. So
I suspect that often that happens in the beginning.
Yes, our loss ratio is actually still quite low, so we've got a loss ratio of less than 8%, so that's the total amount written off as a proportion of our total investment. So bearing in mind our total portfolio is still relatively young, so the average age of our investment is 2.5 years old. So that will probably go up. So as an SES investor in particular, you do have to expect a portion of your investment, of your portfolio to be written off, but that is going to be more than offset by the winners in your portfolio. So if as long as you've got some companies in your portfolio going up in value 5, 10, 15, 20 times, that more than offsets a few failures in the portfolio. But as I said, because we spend so much time as part of our due diligence making sure that the money is lasting, our failure rates is actually quite low. Now, that's not in itself a success metric, because you're looking for successful exits, not just not having failures. But it's really important that the overall startup failure rate, I think, sometimes is due to the fact that companies, founders, maybe a bit overly ambitious at the beginning and spend the cash too quickly before they've achieved the targets, and therefore can't raise a new round, etc. So we make sure that doesn't happen as much as we can. And what's been interesting is during the pandemic, because of all the various government-backed support programs, our failure rate dropped. We had very, very few failures since the beginning of the pandemic, because the bounce back loans, the future fund, obviously the furlough scheme, etc.
Yeah.
At the ES stage, though, we do expect a much lower level of failures, because we're investing in companies that we consider really superstars. We expect some of the portfolios not to have any failures.
And you mentioned about a partial exit. What about other exits that you've had?
Yeah, so that's actually quite an interesting trend. So the ability to provide liquidity to our investors sooner than you would have otherwise, having to wait for a trade sale or an IPO. Onfido is a fantastic story, but it took them 9 years to get to IPO stage. So you have to be quite patient. So it's really good when you have the opportunity to sell a portion of your holding to a new investor in the company. And usually those deals are done at a very good multiple. So earlier this year, we sold 20% of our holding in a company called Cognism, which is a sales software company. And that was done at 15 times multiple on the original SES investment. And we also had an ES investment, so that was a 5 times multiple on the ES investment. So really good outcome, provide a bit of cash to our investors, shows that we're on the right track. We also had a few trade sales. So we had a fintech company, a pension aggregating tool called My Future Now, acquired by Legal & General a couple of years ago. We've got one exit, which is not publicly announced, an Internet of Things company being acquired at the moment by an industrial player. So we do have it's really interesting that we have a mix. We're seeing a mix of exit opportunities as well. So we can provide liquidity to our investors early on. By the end of the year, we'll have reached the 10 exit milestone, which is an important milestone for us. and we expect the rate of exits to really accelerate as the portfolio matures now.
Well, you've got a lot of experience now in this area in a number of years. So what would you say an investor, how long should it take an investor to start getting returns?
We tell our investors to have obviously a long-term horizon. So our target is to achieve the target return of the fund, which is a 3-time return on your money, excluding tax relief, within 6 to 7 years with the SCS fund, and within 5 years for the ES fund. Now, what's been really interesting is that so I've mentioned we've had 10 exits so far. A lot of these exits happen just after the 3-year holding period. So what we're seeing is that there are actually the universe of exits is expanding, and we are able to sell our holding in some companies earlier on than we previously might have expected because of the secondary deals that I mentioned, because of other routes, other exit routes. But in terms of generating the larger exits, you do have to have a long-term horizon. I mentioned on Fido that took 9 years to happen. When an event like that happens, a single exit can return, can achieve the overall target of the fund, but you do have to be patient. On the ES fund, because we invest typically on average 2 to 3 years after our first investment, we therefore expect the exit horizon to be 2 to 3 years shorter.
Yep. Finally then, for investors looking to invest in SDIS or EIS this tax year, why should they consider you? Sure.
So if you're considering SCIS, I would recommend you consider the fund that's got the largest, longest track record. We're the only fund, SCS fund, that has done so many investments, has had so many exits. I think we've really developed a good method in terms of good expertise in terms of SCS investments. If your risk profile is maybe a bit lower, you want to invest in more mature companies, our EIS fund is very much suited for this type of profile. We invest in companies that have achieved the milestones that are not going to be in other EIS funds portfolio, because we are existing investors in these companies, and typically we have this unique deal flow. But our EIS funds also been very much designed for the hundreds of people who've invested in our SCS fund and want to double down on the winners and increase the exposure to companies that can deliver very large returns.
Joseph Zipfel of SFC Capital, thank you very much.
Thank you.